Hi, everybody. Welcome to Demystifying Social Media for Mortgage Loan Originators. This is Leslie Benjamin. I'm with Strategic Compliance Partners. We appreciate you joining us today. Today's webinar is going to be presented by Ari Karen of Strategic Compliance Partners. This is also in conjunction with Gremlin Social Media. Just a little bit about Ari. Ari is SEP CEO and principal in Alpha Kerman's Financial Institutions Regulatory and Labor Employment Practice Groups. He's an experienced litigator and speaker who has focused his practice in representing financial institutions in both government investigations and litigation before state and federal trial and appellate courts nationwide. His practice is diverse. He represents clients on matters concerning banking regulations, Dodd-Frank financial reform laws, contractual disputes, employment discrimination, fair lending matters, and non-competition claims, among much more. Chris Maloney is CEO of Gremlin, a leading social media and digital marketing company that focus on helping businesses maximize their social media programs. He was the former Chief Marketing Officer for Wells Fargo Advisors, Experian, and Scottrade. He's a big believer in the power of marketing to drive business growth, and his experience is driving companies to be highly successful in their digital and social media presence. So I'm going to hand it over to Ari Karen, and we'll begin.
Thank you, Leslie. Next slide, if you could. Great. So I kind of want to start big, and then we're going to get into the details. As Chris is going to explain in a few minutes, I personally, and I know he doesn't believe you can ignore social media. I mean, with all the millennials and just with all the competition out there with other lenders, it already is becoming a significant source of business, but that's only going to increase as technology advances and there's more and more products and the ability to do more and more things faster and mobile. So, social media, whether you like it or not, is part of the future. And with that, you can't sit there and just ignore it because it's kind of hard to do. But I actually don't necessarily think that as hard as it may seem to navigate, with the right protocols, with the right policies and procedures put in place, it can be made much more simple. So the idea here, I think, for companies is when they get into social media, don't get in and then try to figure it out and do it by little approaches here and little fixes there. Come in with like anything. We're going to championship weekend in a football game, right? You start a game with a plan. It doesn't always work, but you start with a plan. And I think that's the key thing you have to do when you're dealing with social media is come in ahead of time with a plan of how am I going to set this up in such a way so that my regulatory burdens are minimized. That's the key thing that you have to do, and where people get in trouble is to just kind of get into it and then figure it out. You don't want to figure it out. You want to start with a plan and then execute on that plan. And that'll diminish your risks. Next. Slide, please. Thanks. And you can kind of just go through the slide very quickly, and you can even skip to the slide after that. Essentially, there have been put out numerous bulletins about the things that companies have to worry about in social media. I listed some of those on the last slide. I know you guys are going to need copies of them so you can look at that. And lots of people have talked about those things already, so I'm not necessarily going to go through those. There were a couple, though, I wanted to mention on the second slide, which people haven't talked about as much, and I think are really significant, which are, claims under defamation, trade secrets, SAFE Act. I'll just give you an example of the concerns I have and the significance beyond the obvious stuff in social media, disclosures. We know about a lot of that stuff. But it's the things you don't think about that can really bite you. So, for example, I had a client one time, and one of its loan officers went out there and literally copied verbatim the advertising of their former employer and just put the new employer's advertising name in that advertising and put it up on the web. Now, this happened to be copyrighted materials. Now, under the copyright laws, that kind of infringement has a mandatory penalty, especially if they've done certain trademarks on it, up to $10,000 per violation, which would be considered, per day in this case. So this thing had been up there about a month and a half. So 45 days times 10,000. Right? It's actually that's a lot of money, right? That's $500,000 right there. So, and there would have been literally no defense whatsoever. okay? We were able to get out of it for not nearly as bad a sum. But the point being that, when you have a kind of mistake like that happens, and that's beyond your regulatory. What happens when someone says bad stuff about other lenders? I've been in lots of lawsuits where people say, either your guy said or we say your guy said stuff about companies with defamation. Under the Lanham Act, it's treble damages, attorney's fees. There's real risks of not monitoring what's going on online. So for those people who might be thinking, well, can I go online and just kind of disclaim it and say it's not really my responsibility because, I don't tell them they have to do it. I tell them they can't do it. They do it anyhow. It's not my problem, right? Number one, the regulators don't see it that way anymore, but certainly private plaintiffs don't. And, that kind of approach, even if it somehow did diminish the liability, which at this point it doesn't anymore, on some of those regulatory things, it's not going to help you if one of these things happens too. And these aren't just Pandora's box. These are awful things that could happen. These are real examples of things I see happening every day. So you can't ignore those. Next slide. And this is, I just want to highlight very quickly, it's a AmeriSave case. A lot of you guys might know about it, but I do think it's important to mention because what happened in AmeriSave is they put out stuff on social media and the links for certain disclosures didn't work, or if they were there ever in the first place, I don't know. But the other thing is they sent it out to everybody, and it happened to be a very specific product. So they sent out something that said, hey, we've got a new product. I don't remember what it was. I'll make it up. No closing costs, right, for our borrowers. And there really should have been, you had to have a 780 credit score and it had to be a 60 LTV to qualify. Well, because most of the people who received this didn't have those types of opportunities, there was liability and there were no disclosures, so everyone who came and said, listen, it was a bait and switch. And so you have to be really conscious of that when you go on social media. How are you going to deal with disclosures? What can you do and not do with hyperlinks? Can you use them? Generally, the answer is not. And there's other solutions for that, which I know Chris will go into. And then the other thing you have to do is who are you going to target this to, and make sure if you have advertising that the content it clearly demonstrates who it's intended for. So you don't have a general advertisement going out when maybe 10% of it, 10% of the people it might actually apply to. Next slide. Now looking at, there's two big challenges I see, okay? And the lenders are between a rock and a hard place. And the reason I say is on one hand, you've got your banking regulators, right? They want you looking at every single thing that ever happened in social media ever, right? They want you to look at every email. I mean, you can't examine it enough because remember, from the CFPB's perspective, and that does funnel down to the states, and certainly to the other agencies, you are responsible for everything that happens with your customers and your borrowers. And so, if you've got something out there and it's wrong or it misstates or it violates the law, at this point in time, look, 5 years ago, maybe they were okay with you saying, well, what am I supposed to do? But there are tools out there now to deal with it, right? There are social media tools and practices, and other lenders have adopted them. About looking at stuff and monitoring it, and they've made it really clear it's your job to do so. So the whole, what do you expect me to do, or I can't review that carefully enough, to some extent, it's not going to apply. I mean, maybe if you're trying and there are things that, notwithstanding really good policies and practices are in place, they sneak through, okay, you might still get away with that a little bit, but you got to be monitoring. That's key, and you have to have in-depth, extensive monitoring of social media. They expect that. Here's the problem. Next slide. The National Labor Relations Act, okay, and that does apply to you as lenders because it applies to all employers. Now, I realize you don't have unions, and so much of the NLRA does not apply. But even without unions, something people don't realize is there's a term called concerted protected activity under the National Labor Relations Act. Concerted protected activity is essentially anything that an employee does that discusses the terms, conditions, and other matters concerning the employment relationship. And so what's happened in other cases is that employees have taken to social media to complain about a boss or to complain about working conditions or what it might be. And then a case law developed out of the National Labor Relations Board, who implements the NLRA, to say that, listen, if you monitor social media too closely, or if you have policies and practices that could somehow cramp the expression of concerted protected activity on social media, then they violate the National Labor Relations Act. And there's multiple cases along these lines. Okay, this is not just one kind of harebrained judge. These are all over the place. And so anything that has the effect of chilling conversations could be effectively a violation of the National Labor Relations Act. Now, if I'm the employer and I'm saying, hey, give me your password to social media, or I'm going to review every single post you make, could that not have a chilling effect? Of course it could. And such rules that have been passed have been struck down. I mean, the limits on what an employer could do under the National Labor Relations Act are just shocking, okay, in terms of there's policies that you can't even, anything that would be, there's one, for example, where an employer had something that said you cannot share any confidential information on social media. And the National Labor Relations Board interpreted it to say, well, that would mean we couldn't complain about our wages in social media since wages are somewhat confidential, and as such, this is an overbroad policy and has to be struck down. And they found for the employees in that case. So the point is, you're probably sitting here saying, what exactly am I supposed to do, right? On one hand, I've got the banks, the bank regulators who say, look at everything. On the other, I've got the National Labor Relations Board saying, you can't look at anything, right? It's a tough spot to be in. So here's the solution that I think you should go to, that you should consider. If you can go to the next slide. And actually, before I even give you a solution, there is one other thing about this that I probably should have mentioned. Remember, you also have liability as an employer on social media. So what happens, like the famous Delta Queen of the Skies case? That was probably the first social media case. They saw on social media something that they didn't like, that they didn't think was really good for the image of their company. It was a stewardess dressed in a Delta uniform, provocatively kind of posing inside an empty plane, and they fired her for it. Delta paid a lot of money for that because they said it was a violation of free speech rights under various state laws. So you can also find all kinds of stuff in there that you don't want to know as an employer, because then you're charged with knowledge, or you may find out and you want to act on it, but you can't. This is some of the areas where better, ignorance may be bliss to some extent. Next slide. So going back to that rock and hard place. So here's the solution. And I'm sorry I'm speaking a little fast because I want to leave plenty of time for Chris to get into some of the devils of social media specifically and how you do this. But the solution, I think, is to create company-facing pages and websites or media sites for loan officers so that they can put their business social media on a business page that you tell them outright you are going to monitor. And you stay at the same place. So in other words, you have two personalities online, social media. One is going to be your independent life. Do whatever you want, right? Don't really care. It's on, that's your personal business. Password protected, so you don't do anything that's going to embarrass the company, fine. But that's your life. That's your Facebook page, right? But if you want to have realtors coming and customers coming and checking out things about business, then you send them to this other page, which is one we're telling you in advance we're going to monitor. And because you create this dual channel, one that is not going to be monitored and one that is, and you create rules and practices that say, listen, anything that relates to the business of doing loans, that's going to involve customers, that's advertising, that's marketing, that's going to reach out to people, anything like that has to be on our page, right, on our facing page that we create for you. But you want to talk about, the night out at the bar on your other Facebook page that's personal, that's not going to have any business information, that's your business. But where it's here, and we're not going to monitor it. So that gives them the channel to use social media on one hand, and it gives them the benefit of having a fully vetted, monitored social media presence for banking, for business. And you essentially follow the rules of both, right? In other words, the banks are happy because all the banking stuff, that's going to be monitored. The NLRA is happier because they can have as many social media, Facebook, whatever they want to do on their personal page because we're not monitoring it. So you don't create the chilling effect under labor laws, but you do monitor from banking regulators. That's essentially the way I think that you should set it up. And again, that's set up with rules, policies, and again, some level of IT setup to get this done and set up correctly. But if you set that up at the outset, it becomes much easier to do it. And the other thing I think you should do and consider is some form of technology so that you don't have, employees, even if they're on your bank, facing pages. It's really hard to keep up with social media. And the biggest problem with social media is once it's up, and you can't take it down. Even if you take it down, someone can print off what you wrote. So to me, a solution, and one of the reasons that I work a lot with Gremlin, is because their solution takes stuff down before it gets up, in other words, prevents it. To me, that is a critical element of what you want to look for in a social media presence, because what it does is essentially prevents the problem from happening before it happened. Things that deal with it once it's happened, look, they're much, much better than nothing, okay? I mean, they're still good. But I think better is to have something that prevents it from going up in the first place. That's obviously safer for you. So those types of technologies I think are very important in monitoring. With that, I'm going to hand it over to Chris.
All right, thank you, Ari. This is a fascinating space because it's moving so quickly, and you have a lot of legal information out there about social media, and a lot of things that have been said by the various regulatory bodies that's still rather vague, and so it leaves things open for interpretation. So I'm going to give you our best understanding. We've worked with about 100 financial institutions on their social media program, and I previously built social media for 3 different financial services company, Wells Fargo, Experian, and Scottrade, and we'll bring some of what I've seen as best practices to the discussion today. From a marketer's perspective, I think you have to look at why you're doing social media and make sure you understand the positive and the upside and the reason that we're doing this. And so I start off with some goals. Number one is we've seen social media, especially those who have a very robust social media presence in the lending business, able to generate leads directly from social media. I have a lender who I was talking to on the phone yesterday who indicated they're able to track 1 incremental loan per month per loan officer directly from their social media activity. And that's just what they're able to track. So we're looking at this being a low-cost, high-impact way to grow business and to increase leads. We also see it as an opportunity to deepen relationships with existing customers, to publishing of content through thought leadership, et cetera, as well as an opportunity to educate customers. With all the regulatory changes in the lending business, the average Joe consumer is often very confused by what they should or could do, whether it be on a residential loan or a commercial loan or a refinance. And so being a thought leader and publishing education can position you and the company in the light of being there to help the consumer and help make this challenging financial product stream more easy to understand. Obviously, compliance is a big driver. We get a lot of calls by virtue of someone in compliance saying our marketing department or our loan officers want to use social media, but we want to make sure we're doing it the right way, so compliance is important. Reputation management, this is both for the individual and for the institution that you represent. We had a lender yesterday that we were doing some work with who had some individual loan officers doing some really unique things, and I'm going to show you an example of one of those coming up here of someone who did something I think everybody will find fascinating. And also considering that this business of lending, a lot of what's worked in the past that's tried and true methods in terms of building relationships and building credibility and leveraging those existing relationships, that all holds true. What social media delivers to a loan officer is the opportunity to take those tactics that have worked for 10 or 20 years and multiply them by leveraging them online and in social media. The opportunity to communicate with larger groups of people, the opportunity to network through tools like LinkedIn, the power is unbelievable. I would say there is no better sales tool for a loan officer that I have ever seen than LinkedIn. And any loan officer who's not logging into LinkedIn a few times a week is missing out. So we're going to share with you a couple reasons why we think you can build your relationships, gain referrals, communicate with partners, and do some really great stuff using LinkedIn. There are, of course, risks, and I'll address risks both from a compliance and a brand perspective. First, I would say that the regulatory bodies here, everybody's favorite regulatory bodies off to the right there, if we had a poll for this particular webinar, I'd have everybody vote on their favorite regulatory body, but we're in a hurry, so we're not going to let you vote. So take a look, FDIC, CFPB. I'll let Ari weigh in as to what his favorite is here. SEC, FINRA. All of these bodies have weighed in point on social media institutions should and how you should be managing your social media. FINRA was one of the most aggressive early on, and they are regulating wealth managers and financial advisors because those are the ones who often have very large relationships, and their advice and a lot of what caused some of the financial challenges over the last 10 years was from that marketplace. And so they've really wanted to step in and be bold about telling financial advisors what they can do. And a lot of these regulatory bodies have listened to FINRA, even though they may not be regulated by FINRA. On the left-hand side, you'll see the 6 things that we see universally that these regulatory bodies feel that a financial institution and lender must have. You must first have a governance structure of who's allowed to do what. You must have a policy that states what they're allowed to do personally and professionally. Ari was great at helping us understand the clash between the different regulatory bodies, and some that want to protect your social media privacy and others that feel your social media presence is a business activity, and understanding that policy and making that clear for your employees is essential. The workflow, who's publishing content and who's approving content, and how is that tracked? That's number 3 there in terms of requirements. Similar to email, one of the fascinating things about social media, and Ari highlighted this as well, social media is viewed by the regulatory bodies as advertising. It's an advertising medium, and early on they believed it was going to be regulated by advertising rules. It is also regulated by customer communication rules, because you're not only talking to the general public, but in many cases you're talking to people who are direct customers of yours who've subscribed to content. And so different institutions have different rules for advertising and customer communication, and social media is both. So your archiving requirements typically would be the same as what you do for how you store emails with customers. And so you must have a platform that archives, whether that be 2, 3, 5, or 7 years. You are required to monitor what is being said about your brand and company, and what your employees are saying about your brand and company, and be monitoring what's going on in any occasion where something you or claiming to represent you. There are situations, too, I've seen from a legal perspective, and I know this from my Wells Fargo background. If someone posts a comment or concern on a website and posts a review where they believe something occurred that shouldn't have occurred, that can be a regulatory flag that the legal department has to be aware of. So you must be monitoring what's being said about your brand aggressively, because if something's said out there about you, you have an obligation to know it and potentially respond to that comment. And last but not least, should the internal audit department or a regulator ask you for a report of everything that you've done or everything that's been said about you, you've got to be able to generate that report very easily, which means you've got to have one of these monitoring tools, potentially archiving tools in place to generate that report. Okay, off of the fun regulatory slide, now I'll talk about some marketing and brand risk. I don't think a day goes by that a news broadcast doesn't talk about someone who's tweeted something ridiculous, whether it be a Kardashian or a politician or someone in the media who's said something or done something that brings them into question. It's even more concerning when that person might be with a company or representing an organization or an institution, and it happens all the time. And so understanding how to protect your reputation, both from what your employees are saying, your representatives of your company are saying, but also what customers might be saying about you, and how are you responding to that, and are you responding to it appropriately? Reputational risk might be one of the biggest things we see in social media. There are risks, number 2, that someone has taken over someone else's account and potentially spoken on their behalf. We hear that a lot in various celebrities and politicians. A simple example that I can give you from a lending organization recently was there is a social media platform that Google has launched called Google+. Google+ is a fascinating platform. When they built it, they intended for it to compete against Facebook. And it has not really been able to compete against Facebook, but what they've done is they've made it an opportunity for you to create your own page, create some content, and they've also leveraged it as a way for a business or a business professional to create a Google+ page. And that can influence how you show up on Google, your Google results when someone Googles you. You may not be a huge fan or a huge believer in social media's business opportunity, but I can assure you everybody knows how often people are Googling things. The term loan officer today is probably being, the term loan officer, or mortgage is Googled 1 million times in the U.S., and in your city and in your town, how you show up is important. We have a lender who one of their loan officers took over and created their Google+ page, and as a result, whenever you Google this company, and this company has about 150 loan officers, you only get the one loan officer. And boy, this guy is bringing in some loans. He's doing a great job. However, he's representing the entire firm, which is something the firm has to look at whether that's appropriate, and that happened by him creating a social media page that took over the overall brand for the company. We also have seen rogue employees. I'm going to show you an example of a rogue employee coming up here who wanted to talk about politics on behalf of his lending firm. But more or less, lenders are innovative folks who want to go out, build relationships, and are aggressive at building their book and meeting new people. And social media is a new and challenging workplace. And there are just some things you have to be sure you've given as guidance to employees and understand when those employees step out of bounds, the best way to bring them in line, and not necessarily clamp down on them because you don't want to kill their enthusiasm for social media, but you want to make sure they're not doing things that misrepresent the brand or put you at a legal or compliance risk. Brand jacking is a situation where someone takes over another brand. We had a really strange situation where someone was claiming to be the president of a lending organization on their LinkedIn page, and they weren't affiliated with that lending organization. So having ownership of who says is with your company and brand is important as well. And then last but not least, just the fear of missing out. It's something you have to know what's being said about your brand, and every time we have the opportunity to do a social media brand audit for one of our customers, we find things that they find both interesting and concerning, and I think it's something you may want to do if you haven't done already. So here's a lender, a loan officer, and we've changed a bit about his information and edited it so as to not get the individual in trouble, but they're a residential mortgage specialist, and they're telling all of their real estate colleagues who are interested in the real estate market that if you want the market to flourish, you must vote for Donald Trump, that he's the only guy with a plan to grow the value for the marketplace and help the economy for housing, and that their company is recommending everyone vote for Donald Trump, and he's attached an article that you can see there that has to do with what we've learned about real estate from Donald Trump. And then another lender responds to Bob and says, great article, I'm impressed that you guys are backing Trump. However, my boss wants me to root for Bernie Sanders. These are Facebook posts that I think if you're with a lending institution, on the one hand, you might find them humorous. On the other hand, you may want to give guidance to these lenders that this is not the right place to get into politics. And representing their company's position on politics presents a risk that I'm not sure it's a compliance or legal risk, but I do think it's definitely a brand risk. And in some cases here, I'll have to chat with Ari about this after our meeting here. There are potential implications here when someone says they're representing a company and that company is endorsing a political candidate. There's potentially an issue there as well. And then Bob the Mortgage Man continues by tweeting on why everyone should vote for Trump in order to save the real estate industry. So more examples just of the things that you should be concerned about in terms of rogue employees. The next thing I want to talk about are some of the myths that are out there, and these are things I've heard from lenders over the last year who have said they're concerned about something and whether they should or shouldn't do something. Number one is that regulators don't want loan originators on social media. That's completely false. The reason that they're putting all this guidance out there is that they know that it's good for the industry to have guidance, it's good for companies to give guidance to their employees, and ultimately it's happening. It's like saying we're not going to do email, 10 or 15 years ago, and I worked with a financial institution that said that. They didn't ever want to do email, and they eventually had to come around. The reality is you have to get on board and acknowledge social media is the new communication vehicle. It's probably going to be bigger than email and texting combined. It's growing faster than any other communication channel, and the regulators know you need to be out there, and they're not opposed to it. They just want you to do it right. The second concept is that if we do social media, we're going to bury the compliance department with workload. And out of the gate, I would say there is definitely an increase in workload when setting rules and policies, but ultimately the tools and the technology that are available to manage social media can turn this into a very streamlined process. We've obviously figured out how to manage thousands and tens of thousands of emails within our organizations. Social media is no different. You just have to have policies in place and tools in place so that you don't make it a compliance issue. If you try to do it manually and you try to wing it and you try to ignore it, yes, I think it could be a real compliance headache. And that's one thing Ari mentioned earlier is don't ignore it. Take an active approach to managing it. Some people think there's no business benefit to social media. I've seen some great examples to the contrary. For example, among financial advisors, there's a research every year by Putnam Investments, and Putnam found that the average financial advisor who's actively using social media is bringing in about $5 million a year in incremental assets purely through their social media activity. In the lending space, we have lenders who bring in 1 to 2 incremental loans a month through social media. It's as important as anything that they're doing and probably much lower cost than a lot of other advertising or marketing they might do. Hey, only kids are the ones using social media, not my customers. I hear that all the time, especially from senior executives in financial firms. They talk about their kids being on social media all day. And the reality is, if you know this, Facebook has now become the home for the boomer generation, and all of the Gen Y and millennials have moved on to something else, whether it be Instagram or Snapchat or something that we haven't even heard of yet. Facebook is one of the places where we're seeing huge growth among boomers, and among white-collar professionals, it's LinkedIn. Twitter is a smaller network. Probably only a third of the people are ever going to use Twitter, but it's a powerful tool for those who do use it, and that's not for kids anymore either. I don't have time for social media. I understand that. Hey, I wake up this morning and I asked my iPhone, how many emails I had, and it said that I had 25 new emails this morning. I don't have time for email, but guess what? It's part of life, and it's like social media is going to be. You might need 10 minutes a day, 5 minutes a day, maybe 15 minutes a day to take a look at what's going on in social media, but it is something we have to make time for. And ultimately, because of the way social media delivers you content and information, I believe it can be a real powerful tool. One of the coolest things about social media is if you can set up alerts for what's happening in your network for people you care about. So for example, every Saturday I get an email that tells me among my 575 connections on LinkedIn, and all of these connections are business connections, people I've met or done business with. I don't just accept every connection from every random person. That's always a risk. But among these 575 connections, about 10 every week change jobs. 10 every week change jobs. That's an interesting opportunity. If I'm in finances, do I think maybe there might be rolling over some of their financial accounts from one institution to another? Is it an opportunity just to reach out and congratulate them on their new role? That is worth the time. That's relationship building, and it's information that's being freely given to me by those colleagues of mine, and it's a real opportunity to leverage building relationships. It's worth the time. LinkedIn is for getting jobs. I'm not looking for a job, or at least I don't want anyone to know I'm looking for a job. So 3 or 4 years ago, I do believe LinkedIn was largely viewed as a job site. Over the past 4 years, LinkedIn has completely shifted their business model. They are not about helping people get jobs. They are about people networking. It is the most powerful CRM tool out there, and I have dozens of stories of people who gained new business by effectively having a profile on LinkedIn that made sense, networking with the right people, and occasionally posting content that was relevant to your audience. It's an unbelievably powerful tool, and it is no longer about resumes and getting a job. I'm intimidated by the tweeter. So Twitter is one where whenever I speak at a conference, usually the first 3 or 4 people who come up to me after the conference are wanting to ask me about Twitter because they're confused or frustrated by Twitter and they don't understand Twitter. And the truth is, master LinkedIn first, master Facebook second, and then after you feel like you're a Jedi at those two, take a look at Twitter. Twitter is not going to be for everyone, but those who use Twitter find it incredibly effective at getting them information and allowing them to push out information. And as an institution or a lending organization, once you start to get hundreds or even thousands of followers, you can distribute content and information more quickly that's shared, reshared, re-reshared. It spreads rapidly through the Twitterverse, and it's a very effective communication vehicle. But don't be intimidated by it. I would recommend signing up for an account and listening to what's being said out there for a while, doing some searches, and just getting comfortable with it before feeling you have to master it. Social media is not meant for business. That may be the theme of this entire webinar. It is meant for business. It is essential to business. It has become essential over the past couple of years, and what we're seeing is some of the smaller, more nimble lenders who are able to do social media are leveraging it better than the larger organizations, and it's an actual opportunity for the Davids to beat the Goliaths. So I know we probably have a combination of Davids and Goliaths on this call. We had over 100 organizations register for this webinar. So we have a mixture of all the above, but I can assure you if you're with a small to mid-sized firm, there's a real opportunity for you to use it for business. Or you might think my lender is too far behind or too scared of compliance or legal and the auditors, and I think between what you've heard from Ari and me here at Gremlin, there are definitely tools, solutions, and guidance, and no organization, no matter where they are in the process, should be intimidated. Dive in now. It's the right time to take advantage of this platform. This slide is one that normally is a build, but in order to save time for everybody, we condensed it into one slide. The one thing I want to talk about here, this is our view of how social media has evolved for business purposes. 10 or 12 years ago, what we really saw on the far left there is people talking to people in social media. People chatting with people, people posting reviews, people putting comments out there, on blogs and commenting on blogs, and just a lot of chatter going on. This was, if you can imagine it, before Facebook really took over. This was back when MySpace was dominant. People were talking to other people. I was working at Scottrade as Chief Marketing Officer in 2007, and we implemented a listening program because we said, wow, our brand is being spoken of a whole lot out there. We need to know what's being said about our brand. So we did a social listening program, and I was getting weekly reports on what was being said about us. In 2010, the large financial institutions built social servicing departments where people were then responding to tweets or responding to posts on review sites or websites, Facebook or LinkedIn or articles or blogs. You'll remember some pretty interesting stories earlier this decade, such as United Breaks Guitars being one of the most famous, where United Airlines damaged a guitar of a musician, and the person couldn't get an effective response from United about whether they were going to help pay for the guitar, so they wrote a song about United, and tens of thousands, maybe now hundreds of thousands of people have viewed the United Breaks Guitar music video, and that was definitely a bad thing for the brand, and it taught a lot of companies that they need to be out there responding quickly to complaints or concerns from consumers. Social branding, I believe, in 2012, especially the larger financial institutions admitted we have to have a Facebook page, we have to be out there, we have to own our LinkedIn page, we have to understand the social media dynamics and have a brand. And you'll see there the companies talking to the people, the green dots, And that was a huge step forward, and most large financial institutions have acknowledged that they need to have a social brand, a centralized department or person who manages their social voice and their social material. What has really changed in the last couple of years is the top right, what we're going to call social channeling. So the two figures in the center there, right in front of the business, the man and the woman representing the business, those in this case would be loan officers who are now, for purposes of social media, the face of the lender. And it is as important that those individuals have a rock-solid social media presence and a good LinkedIn page and understand their Facebook presence, because their name, their personal brand, is representing the institution. And I've had the opportunity now to get about 10,000 people who were relationship managers to acknowledge they need to have a personal brand in social media. And this is a wave that we see taking over in the next year or two, and it requires a strategy. It requires some education regarding the value of social media, and it also requires some tools to make it easy, because those individual loan officers are not social media experts. Some tool like Hootsuite might be great for marketing, but it's going to complicate and confuse that loan officer, so they need something that's easy for them to work with. So we talk about curriculum in terms of where you should start and where you should go on social media. And there's 4 levels that we talk about in terms of understanding social. Social 101 is that you should have a solid profile. Every senior manager at a lender, every relationship manager, and every loan officer should have a profile that contains everything it needs to share who you are. It is your digital billboard. It is your digital business card, however you want to look at it. It's essential. And we're going to go into greater detail on what is included in that social profile. In future discussions, there are 2 other levels that we talk about. One is the 201 level class, which would be how to build connections and who you should be connecting with. In a nutshell, I'll tell you, don't accept a connection with anyone you wouldn't go to lunch with or have a business meeting or call with. The purpose of connecting with people in social media, especially on LinkedIn, is that you know who they are. That changes on Twitter. Twitter is largely about connecting with people who share interests to you, and maybe people that you never meet, but who share interests. LinkedIn, I would say, connect with people you go to lunch with. Twitter, connect with people you find interesting. And Facebook, I'm going to bring to a whole nother level. My philosophy of Facebook is, don't be friends with somebody on Facebook unless you bring them over to dinner at your house. Now, there are some exceptions to that I'll get into later, but Facebook is a very personal platform. Number 301 is content. So this is where you start publishing content. It doesn't have to be material that you wrote. It could be that the local business journal has published their outlook for 2016 on the housing market, and your audience might find that article particularly interesting. I think it's a fascinating way to get content out, having you look at articles that might be out there, scan the marketplace, and share a few articles with your audience that are appropriate and from reliable sources. Inside the Gremlin tool, we have a library of content that makes it easy for the marketing department to post content and then for loan officers to share that content. And it's good to have some sort of system to make that content distribution easy. And last but not least is the pinnacle. It's social CRM. And I've seen loan officers who are leveraging social media where they're using LinkedIn every day, and they're building their business effectively by using it as a CRM tool. A little bit more about LinkedIn. LinkedIn has 332 million users. By and large, 85% of all white-collar jobs in the U.S., those people have a LinkedIn page, so it's a great way to connect with professionals and for you to have your personal brand represented. What's included in a profile? So we mentioned this earlier. The musts are a good photo and headline. Your headline is not your job description or your title. It's the very top of the LinkedIn page, and it describes who you are and what you do. A summary of your history. There's a section for you to talk about yourself holistically, not about your current job. You should have your key jobs in your history. If you've moved between 2 and 3 companies, they should all be listed. Their logos should be listed. It builds your credibility. Your contact information should be there. Any community activity or involvement that you have is often beneficial. You can actually be endorsed for skills on LinkedIn if your company allows it. So it's almost like getting endorsements from people who've used you, that you're an expert at home loans or mortgages or other capabilities. Your education, your company logo, you'd be surprised how many people are attached to the wrong company or don't have the company type right, so their logo doesn't show up. Use keywords that might help people find you and what your specialty is, and share a little bit about your personality, and then obviously any skills or endorsements or certifications you have. That's what I'd call LinkedIn 101 for profiles. The basics of Facebook. Now, Facebook is an interesting channel. There's over 1 billion users worldwide. Everybody knows Facebook, and so Facebook for Business might be a little bit different. My recommendations for Facebook for Business is this. First is, do you want to use your personal profile or do you want to create a business page? Teams, branches, and individual loan officers are entitled to create their own Facebook business page. That business page is different from your personal Facebook page, and as we talked about some of the rules, NLRB and whatnot that Ari was mentioning, there may be justification to create 2 separate pages to keep those 2 worlds separate, having a business Facebook profile and a personal profile. If you do have a personal profile and you use that for business, be sure you're very conscious of how people are posting to your Facebook page. Like you said, you don't want too many pictures of bars, or I had a loan officer, or actually a financial advisor at Wells Fargo went to a fraternity reunion, and his fraternity reunion buddies took pictures of him and posted both old and new pictures on his Facebook page, and he lost business as a result of it. So you have to be very conscious of what's on your Facebook page. Have a profile and cover images, information on who you are. You can have your current job and role, contact information, community activities you're involved in, share something about your personality. But again, my final bullet there, be conscious of mixing personal and professional on one page. Facebook requires a little more thought than LinkedIn, because LinkedIn is strictly business. And then on Twitter, for those of you who are thinking about Twitter, you get 140 characters to say something. There are 500 million tweets per day. There's some really cool things you can do by sharing content and retweeting other people's content. We're a big fan of Twitter, but again, only about 30% of people who are active in social are going to use it. Those who are using it have found it very effective, and you can spread information very quickly. So some basics on your Twitter would be, you're going to have a handle. If you don't have a handle yet, you may want to go get a handle that's your name or something about yourself, like, you know, mortgage lender Bob, or whatever the case is, a handle that makes sense for you. Secure it now, even if you're not going to use it until later. Have a profile, a picture, a background, and a personality, and consider who you follow and follow back people who follow you, and how to use Twitter search. Twitter search is a powerful tool to see what's being said about your brand or your industry or a topic you're interested in. Choosing the right networks. We talked about Facebook, Twitter, and LinkedIn. Those are the 3 that come up most often. We also do evaluations for lenders on whether they should be on Google+, Instagram, and YouTube. There are greater risks and different opportunities on those platforms, but the fundamental 3 are LinkedIn, Twitter, and Facebook, and then take a look at the others if you're interested in expanding once you've mastered the first 3. And then our last discussion here will be about what we see as the technology and what you should have in a platform. The platform that you leverage to manage social media compliance, I believe it has to be easy to use, both for marketers and for loan officers and relationship managers. You may even have situations where or on social media. I have a financial services institution where not only the lead person is on social media, but all of their client-facing team members are. So opportunities to make it easy to use. The tool should have a marketing library and a way to publish content that's been approved and to show what has been approved. Setting up of a content calendar. So just because you decide to tweet at 2 in the morning doesn't mean anybody's listening. And so looking at the times of the day that's most effective for your content. My colleagues here have done some research into what those times of day and days of the week are, and so how to schedule that content when it's going to be most effective, that's important. We've spent a lot of time talking about the compliance and governance structure. I won't spend any more time about that. And last but not least, make sure you're measuring and tracking what's working. social media will require a budget and will inevitably add resources over time. Showing the impact that social media has in growing your business is the best way to justify getting incremental budget. I know that. I had to go through that at Wells Fargo. We spent a year building a business case and showed the impact, and were able to get a very significant budget the following year by showing the impact it would have on the business. So takeaways from today in conclusion, and if anybody has any questions and is able to enter a question into the question field off to the right there, feel free to do so. We'll answer questions here in the remaining 5 minutes of our time. But number one, key takeaway is make sure that social media is in addition to your in-person networking. There's a fascinating case that I read about LinkedIn where instead of people getting business cards, as soon as they meet people at an event face-to-face, they pull up their phone and immediately connect with that person on LinkedIn. I was fascinated by that article, and I tried it at a recent charity event for the United Way. I connected with every other business person that I met directly in the event that I was at, and all 10 of them accepted my request, and it was a really great way to remember who you met and be connected with them. So in addition to the in-person, use social media. There is risk, but there's huge opportunity. Don't be afraid because of the risk, and Ari is an expert on this and can help anybody that has questions about how to manage the risk as we can as well. And don't be scared. The opportunity is huge. Technology can make things so much easier for banks and lenders, and the regulators want to see that you're doing governance. They want to know that you have a plan in place, and so aggressively come up with a plan and implement it. Clients, prospects, and referral partners want to talk to you on social media. I mean, it happens every day for me in my space, of course, that somebody says, hey, I'll connect with you on LinkedIn, or I get a LinkedIn email from somebody asking me for something. It's become a new method of communication for a lot of people. And last but not least, our final point is that loan officers at all levels of expertise can grow their business by using LinkedIn, Facebook, and Twitter. It's a growth opportunity that shouldn't be overlooked. All right, so this is the final page for contact information. Our head of marketing, David Bell, is listed there with his phone number and email if you have questions about social media marketing and social media brand. And if you have compliance questions, Ari's company, SCP, is listed there, info@strategiccompliancepartners.com. Feel free to reach out to them with any questions that you have as well. And of course, connect with Gremlin on Facebook, Twitter, and LinkedIn. You'll get a lot of information from us there. Let's see here. We have a couple of questions, and I'll try to answer a few of those now. So there was a question about discussing solicitation. I may see if Ari wants to take that one. It says, can you discuss solicitation? The next question is, will we get a copy of this presentation? Yes, we're actually recording this presentation, and we will send out a link to share the recording as well.
Chris, I'm not actually seeing the questions on mine.
Yeah, they're off to the right there, and the one that I will read to you that's addressed to you is, because Ari mentioned that there were opportunities for employees to have personal and professional pages in social media. How would this work with LinkedIn and a few other platforms? So let me take a stab at that, Ari. I think
I think it's better. That's actually a better question for you, I think, Chris.
Sure. In the case of LinkedIn, I would recommend that you have a single page as an individual with your history and all of your information. We have seen occasions where lenders will have a company page, and therefore that individual should be attached to the company page, and possibly content is being published or shared on that company page that shows up as well for that lender's connections, that loan officer's connections. We have also seen occasions, depending on the structure of a lending organization, where teams or branches can have their own page on LinkedIn, and that's an option as well. On Facebook, it's all over the board. You can have a personal page and a professional page as an individual person, and you can have both if you choose to do so. We have also seen branches of lending offices create their own Facebook page so that their branch is represented and all their contact information and how to reach that branch is located there. And most importantly, the parent company of the lending institution needs to have a robust page on Facebook as well. And then Twitter, typically you would have one Twitter account that is your business account where you're sharing content, and then possibly a corporate entity. The lending organization might have a Twitter account as well that you're following. So there's a variety of ways to handle that.
And if I could just jump on that, Chris, to highlight a point of what I said and confirm that you're in agreement with me. So, for example, if you wanted to have, I'll just use Facebook or as an example. You could have your personal page and a business personal page, and the business personal page, for example, could be monitored by Gremlin or something like that, and the personal page, as opposed to the business personal page, wouldn't be. And this way you could have everything flowing business-wise to this business personal page and monitored by, for example, your system, and at the same time have the person's personal page outside the monitoring. Is that right?
Absolutely.
Okay.
And as a matter of policy, the lending organization should declare that the personal page is not being monitored, and you probably ask that employee to not discuss business on their personal page.
Right, exactly right. Okay, thanks.
Yeah, very manageable. There's one question here that's a bit vague, Ari, that asks, can you discuss solicitation? And I think this was during your section. I know there's not a lot of information there. Are you able to understand what they're asking for there?
Not really. Can I discuss solicitation? No, I'm sorry. I don't. Can you solicit business by? I'm not really sure. I'm sorry. I need a little more information on that one.
It probably, it came up during a particular section. So.
Yeah. No, sorry. And I can't see the.
Here, let me clarify the solicitation question. That same person has asked again. How would you define the scope of solicitation?
Well, the scope of solicitation obviously is going to be very dependent on various state laws. I think that any time that you were going to have, that you were essentially asking for business and providing any types of specificity of loan terms, and it could be even less than that. It's, look, and not specific loan terms to a person, but just that are available, products that are available. A email that goes out that says, hey, just wanted to attach the article from the Federal Reserve about interest rates. Okay, it's not a solicitation. It's purely informational. I don't see that. When you send something to somebody saying, hey, interest rates are going up, and you're inviting them to contact you specifically for the purpose of talking about a loan, then you're getting much closer. When you say, I have a product that is great, now you're soliciting. Where on that continuum, I don't think there's necessarily a bright line. I would draw it probably above the line when you say, hey, interest rates are growing up, because what are you trying to do? You're trying to solicit that. I realize that that's still the intent when you set up, hey, just sending you out information from the Federal Reserve, but there's no real invitation that you're making or trying to necessarily cause a person to respond to that to seek a loan. You're providing information. I think that's the area between which the lines get drawn.
Thanks. Last but not least, there are a number of questions about whether people can get copies of the slides, and we will be sharing a video capture of this. Also, feel free to email either of the two emails on there, and we can get you a PDF of the PowerPoint as well. So if someone would like a copy, please do let us know, and we can do that on an individual basis. A lot of great comments here and some additional questions we won't have time to answer as we are at the top of the hour. Great discussion. I know I actually learned a lot by partnering with Ari on this. He has a great deal of depth on this and expertise, and we hope you found it to be beneficial as well. This is a really interesting space that's moving quickly, and on behalf of Ari and his organization and on behalf of Gremlin, we're here to help in any way we can, and hopefully you found this presentation to be interesting and insightful.
Thanks a lot, Chris.
All right.
It was great working with you.
Thanks, everybody. Don't hesitate to reach out to us if you have any additional questions. And we know taking an hour of your day is a big commitment, so we greatly appreciate the many people who joined us for this session today. Thank you very much, and good luck out there in the social media world.